Okay. So please give me the figure for the redemption. Give me the figure for the redemption. Please, in our next question now, we will not be doing this trial and error again anymore, right? Obviously want us to understand this, that the 5%, the higher it is, the more your present value reduce becomes negative. While the lower it is, the higher your what? Your present value. Please give me figure for this present value for
0.888.
0.888. Right? So what do we have?
93.
90 what?
93, sir.
Okay,
93.
93. Okay, 93. Thank you so much. Thank you. So what do we have? Final figure. We have positive now, right? We have positive now.
15.5.
15.
Point
Okay.
5.
Okay, positive, right?
Yes, sir.
Okay, thank you. 15.5. Please don't forget that the redemption, we added premium. Please, we added premium to the redemption. That is why we have plus premium, right? So that is why we have this 105, right? That is why we have 105. Don't forget that I said we should change. Please, if you have the material, quickly change the nominal value of the redeemable debt to 100. Please, it is not 1000. It is 100. The nominal value of the redeemable debt is 100, not 1000 naira, please. So that is why we're not able to get the positive and negative NPV since. So now, the next thing is your internal rate of return, right? IRR. So what is the formula for calculating internal rate of return? Lower rate, are we there? Lower rate
Yeah.
plus what? Lower rate plus what? Hey, my people.
NPV of lower rates.
Now,
NPA
NPV
positive NPV.
divided by
Thank you.
plus
I'm coming.
divided by
Divided by
positive
negative.
NPV
Okay. Positive NPV. Positive NPV.
plus
Let me
negative
use.
plus
NPV.
Okay, plus. Thank
negative
you.
NPV.
Plus negative NPV, right? Is negative.
Yeah.
Plus negative NPV, right?
Yeah.
Plus negative
Yes.
NPV. Then what do you have?
Minus
You say?
we multiply by higher rate minus lower
Thank you.
rate.
Thank you. Multiply by higher
Higher
rates. God bless you.
minus lower
Higher
rate.
rates minus lower rates. You can see that I didn't put it. That is why we are different from others. We want you to think so that when you see this type of question, you can be able to do what? You use the formula. You remember that IB mentioned this in class now. He mentioned it, right? Lower rate plus the positive NPV, right? Plus the positive NPV divided by the what? The negative, divided by the positive NPV. Why we use plus is because plus times what is it called? How do I want to put this thing? The positive NPV, there is minus there already. Is that not so? At the middle, minus negative NPV. Minus times minus is plus. So that is why we said lower rate plus positive NPV class divided by positive NPV plus negative NPV times higher rates minus your what? Your lower rate class minus your what? Your lower rate. Now let's go there. So what will be the cost of redeemable debt class? The lower rate is 2%. You can use 2. Just move on like that. 2, right? Plus the positive NPV. What is the positive NPV? 15.5, right? 15.5 divided by 15.5 divided by the positive NPV, which is 15.5 plus the negative NPV, which is 1.5, times the higher rate. The higher rate. What is the higher rate? What is the higher rate that we use? What is the rate that we use? Okay,
5%.
5%. Okay, 5%. 5, just use 5 and move on. Minus 2, right? So, please, what is the cost of redeemable debt? Right? What is the cost of redeemable debt, class? Class, what is the cost of redeemable debt?
10.8.
Sir, add the rates. I've added the rates. No, don't forget. Don't leave the rates. Forget the percentage. Don't worry. Anyhow that you want to do it. See, that's why I said, see, I can decide to put the rates 2%. See, if you use 2%, at the end of the day, you still multiply by 100. Class, just leave it as 2. Don't stress yourself. You will get your percentage. Oh yeah, now let's see. Let's watch. Let's see. See,
10.8.
10 point what?
8.
10.8, right? 10.8%, right? That is the cost of redeemable debt, class. See, if you use ordinary 2%, class, if you use ordinary 2%, you will get your percentage directly. You don't need to multiply. But if you use 2%, we say 2 divided by 100, you have 0.02. Then the other one, you say 0.05. That is stress. You are just giving yourself stress, because at the end of the day, you will still multiply by 100. So to reduce stress, right, just use 2%. Just use 2 and move on, right? We use 2 and move on. So you don't need to multiply by 100 anymore and move on, right? Now, this is 10.8%. And this is the cost of redeemable debt. Don't forget, after you calculate the cost of redeemable debt, what do you do next? You calculate the total market value of the debt or equity. Don't forget the steps. The first step is to identify the what? The sources of finance, calculate the cost of capital, which is either equity or debt. We've calculated the cost now. Determine the total market value. Now we want to determine the total market value of a redeemable what? Debt. Just like the way we did it last night, right? Total market value, right? Now the total market value is calculated as the market value S interest, because it's per bond, is per 1, times total value of redeemable debt divided by the nominal value, the nominal value divided by the nominal value, class. And the nominal value is 100 divided by the what? The nominal value. You can see. Now, why do you have to do it this way? For those who are in my class last night, how do we do it? Now, the market value S interest, right, is given. We've already it is given already, right? Which that we use to determine the what? Internal rate of return, which is 104.5. You can see it there, right? You can see it. Is that not so? Now, that is per bond, per 1, class, per 1.50. Multiply by total value of the redeemable debt. You quickly go to your capital structure. You go to your financial information, right? This is the financial information. Is that not so? So what is the value of redeemable, which is 3 million, 3,000? Is that not so? 3,000, or you use 3 million because there is 30 up. Class, is that not so? So now you come down and say, oh, it's 3,000. Is that not so? So you now say you multiply. So should we use, okay, let's use 3 million, right? Divided by the nominal value is 100 naira. The nominal is 100, right? The
Hello,
nominal
sir.
is what? Okay.
Sir, for the IRR, I get 4.7.
You have 4.7. Another person should confirm. That's why I
Yeah.
say you should confirm the figure.
See, I've been trying to confirm, sir. It's 4.7.
Okay, it's 4.7, so it's wrong now. So, okay, 4.7. Thank you. 4.7%, right? So, divided by the nominal value, right? the nominal value, which is 100, the nominal value, which is 100, right? Divided by the nominal value, which is what? 100. So what will be the what will be the total market value now? So please, when you want to calculate, you don't add the premium here, because you just need the nominal value. What is the initial nominal value before the premium? That is what you will use. Now, class, let me give you something here. Let me show you something. Now, for those who are in my class last night, right? We said this 3 million divided by 100, right? It will give you 3,000 bond, 3 million bond, right? Now, times this 104 is per bond, per one, per bond, per one. So when you multiply that 3 million bond times one of the bond, is that also, it will give you the total market value of the bond. So what will be the total market value of the bond, class? What will be the total market value? Multiply, figure.
3,435,000.
Okay. 3 million
135,000.
135
135,000.
135.
Yes.
Thank you. Now, this is the total market value of the. You can see we determine the cost of redeemable. We determine the total market value. Is that not so? Now, what is the next sources of finance? What is the next sources of finance? Which is the last one. You know, we have 4 sources of finance from this question. There is ordinary shares, there is preference shares, there is redeemable bond. The last one is what? Bank loan, long-term bank loan. Don't forget that we cannot determine the market value of bank loan. You can see the bank loan here. You can see what they said about the bank loan. It has how many percent interest rate? It's 4% interest rate. So please, the total market value of a bank loan will still be the same value given to you in the financial statement. So the market value will still be 1 million. We can't determine the market value. The market value is still the same amount given to you in your financials. So the only thing we will determine is just the cost of bank loan using the interest rate. Don't forget that bank loan is irredeemable what? Is irredeemable debt. Is non-traded debt. Sorry, is not what? Non-traded debt. A debt that cannot be traded in the what? In the market, right? So I think this is the 4th one. Bank loan, right? Bank loan. Okay, let me push this up. Bank loan, right? Bank loan, sorry, coming. Let me just push it here. Okay. Bank loan. I think this is the 4th one, right? Let me check. Okay, 4th, yeah. So bank loan. Now, who can give me what is the formula for calculating cost of bank loan? The cost of debt for bank loan, cost of debt equals to, who can give me the formula? What is the formula for calculating the cost of debt of bank loan? What is the formula? Who can give me the formula? What is the formula for calculating the cost of debt for bank loan?
Interest, open bracket, 1 minus tax rate.
Thank you. Kai, oh yeah, day your head. Oh yeah, day your head. Interest, interest, 1 minus tax rates, right? Because you cannot determine the market value of bank loan, right? It is not traded. And the interest rate is 4%, right? You now say 4, you need to convert that 4. If they say your interest rate is 4%, right? You need to convert it to Naira. What will be the Naira amount of this interest rate? Class, what will be the Naira? What will you do? Who can tell me? If I want to convert this 4% to Naira, what will I do? Class, hello?
No, before percent of the amount of interest in the financial statement.
Mm, okay, you use 4% of the amount of interest. Okay, okay. Okay. But that one, it will not give us what we want. It will not give us. We need, okay, thank you.
Over
Thank
100.
you. Yes, thank you. Thank you. See, that is why I say, if you want to determine, we need the interest rate. We just want to get what will be the interest that you will pay, right? We just need the interest. So it will be 4 divided by 100 times multiply it by 100, although it is not stated anything nominal, but it is assumed to be times, just multiply it by 100 so that you will get your 7 naira. So you will know that your interest rate is 7 naira, is 4 naira. Is that not so? Is what? Is 4 naira, class. You will know that your interest rate is what? Is 4 naira. Multiply it by 100, right? The nominal value, just multiply it by the nominal value, just multiply it by 100. You assume to be 100, right? In every question, just assume it to be 100, then you move on. Class, 4 over, just because we need to get the naira amount, right? So when you do it like this, you have 4 naira, right? You can now say 1 minus, what is the tax rate? 0. What? 0.3. Is that not so? What will be the cost? What will be the cost? What will be the cost? And someone just use, what will be the cost? Class, quickly, what will be the cost? Hello? What will be the cost? Quickly.
2.8.
Yeah, 2.8%. 2.8%, right? 2 point what? 2.8%. Now, if you want to use that other one, it will not give you what you want, right? But we'll use it at the end of this class. Let's see. Let's test run it. Let's see how it goes. So the total market value will be the same amount. Total market value will be the same amount given to you in your what? In your financial. So we quickly go and check, because you cannot determine the market value of bank loan. You just use the value given to you, which is what? 1 million. You can see it there as 1 million. Is that also as 1 million? Let's quickly go down. 1 million. So that will be the what? 1 million, right? 1 million, right? So if this is established, the next thing is to calculate what? Wacc, which is your market value weighted average cost of capital that they say you should calculate, right? So now, market. Okay, let me bring it down. Let me bring it down. You guys will give me the formula. Prepare to give me the formula for calculating WACC. Market value of weighted costs of capital, right? Capital. So what is the formula? Someone should give me. So what will I start with? Give me the formula.
The
Give me the formula.
items.
Okay, thank you. Items. So after the items, what do you have?
Market value.
Thank you. God bless you. Market value. So after the market value,
Cost of capital.
cost of capital. God bless you. Cost of capital. Richard, have I give you something in this SFM class? Did I give you anything?
No, sir.
Okay. Not yet. No worry. That is not yet. So this is cost of capital, right? Items, market value, cost of capital, right? So what is the next? What
Ash
next?
total.
Thank you so much. Ash total. Ash total, right? So we start from our equity, from where we start from. Is that not so? Which is equity. Please take note of the market value as well as the cost. So what is the cost here? You can see what is the cost of equity. The cost of equity is 0.401, right? Take note of that. Then the total market value. The total market value is what? What is the total market value? The total market value is 837,600. Please take note of that. I will ask so that we will not be going up and down. And you can screenshot it as well. So the preference shares, look at the preference shares. The cost of preference share is 10%. This is 0.1. You can see it, right? Then the total market value is 1.2 million. You can see it, right? 1.2 million, right? So the redeemable debt, the cost, okay, we can do this one. Okay, now let's start, class. Let's start quickly. So you just put equity. You say equity, right? What is the market value? What is the market value? 83 something. What is the market value?
0.4.
The market value is what?
837.
837,
837. 600,000.
600,000.
Yes, sir.
Okay, 837,600. Is that
Okay, it's quoted.
hello? What is the total market value? Ah,
Correct, sir.
okay, it's correct. Okay, no, it's in million.
The
837.
million is quoted.
Okay, so you can see. Thank you. He says quoted. Interesting. Oh, this is it, right? So what is the cost of what is the cost? What is the cost of capital? When I say cost of capital, it means equity, it can be equity, it can be debt. What do we have? What is the cost?
0.401.
0.401. That is the cost. We've converted it. So you multiply it. What do you have? Someone should be giving us the figure for the hash total while we proceed. Then after that, what next cost do we even?
Preference shares.
Okay, thank you. Preference shares. Thank you. Preference shares. Thank you. So what is the market value for preference shares? What is the market value?
1.2 million.
Okay, 1.2. Thank you. 1.2 million. Okay. What is the cost?
0.1.
0.1. Thank you. So next, what is the next cost? Redeemable, right?
Yes, sir.
Okay. What is the market value? Did you capture the market value? Okay, no. Okay, the
3
market
million
value.
100.
Okay. 3 million. Thank you. 3,135,000.
1
So what is the redeemable? What is the cost? The cost is 2.8. Convert it. Convert the 2.8. Convert it. That is 0.028, right? Convert it. 2.8%.
No,
So
sir.
convert it.
It's not
That
0.8, sir.
is what?
It is 0.047.
I don't understand. What is the cost? Okay, thank you.
0.47.
Okay. Thank you. It's 4.7, right? 4.7. So you can that is what? 0. What?
0.047.
0.047. Class, because you need to convert it, you need to just divide it by 100, please. Always divide it by 100. So what do we have? So after that, we have a bank loan. The market value of the bank loan will remain 1 million, still 1 million. So what is the cost of bank loan? What is the cost of bank loan? 2.8. Divide it, what do you have? 2.8%. What?
0.028.
0.
0.028.
Okay, 0.028, right? So what do we have? Okay, multiply everything. What do you have? So please, someone should add. Please volunteer to add the market value. Please add the market value, the total market value. Please, someone should give us figure for the hash total so
Sir,
that we can
that
know.
equity, is it 837,600,000?
Yes, please.
Remove 1 0 there. Okay, thank you.
Please, someone should just give us figure for the hash total. Therefore, Wacc weighted average cost of capital equals to hash total divided by the market value. So what is the Wacc? Wacc equals to this.
The first one is 335 million.
Okay. The hash total, Abi?
Yes, sir.
Okay, is what?
335 million.
335.
335
Okay.
877 600.
Okay, 335. 335,
877
877,
77 600.
600.
Yes, that was to
Next.
confirm.
Yes, it's correct.
Okay, let's move on quickly.
120,000.
The second one is
120,000.
Yes, sir.
Next.
147,345.
Hello, Master. I'm very sorry to draw you back, please.
No.
That equity capital, how did you get 837,600,000? How did you get
Yes,
that 837,600,000?
that is what we calculate last night. That is what we calculate in our last class.
Okay,
So I will scroll up
no,
and
no,
show
that's
you.
fine.
Yes, I will scroll up
Okay,
and show you
let
so
me
that you
just
see
give, just give me the understanding of how the figure came to be.
No. I'm sorry. I can't explain that again. So please, you can check the YouTube and watch the video. I believe you are in the last class, right? You should go and please just go and
I,
watch the video. The
I was
explanation is
I
there.
was in the last one.
Yes. Everything is there. I'm sorry for that, please. Thank you. Now,
Nice.
so what do we have here? What do we have here? Class.
147,000.
Okay,
147,345.
147,345. Okay,
Yes, sir.
okay. Is it in million or like this?
1,000.
Okay,
Like
thousands.
this.
Okay,
Yes. Yes.
okay, cool. So what do we have next? What do we have?
28,000.
20,000.
28,000. 28,000. Thank you so much. Appreciate it. So now, what is the total? Please add the total market value together and add the hash total together. Give me figure.
Total market value
Yeah.
842,935.
Eight
42,935,000.
842,905. Right?
935. 935.
Nine what? Sorry.
935.
Okay, 935. Okay. Next. What do we have?
336
Okay. 336
172 945
172
72 945.
945. Thank you. So therefore, weighted average cost of capital will be 336 172 divided by 945, right? Divided by the market value of 842,935,00, right? So what is our Wacc? What is the Wacc? Wacc
0.40 approximately.
0.40
40 approximately.
or how many percent? That is 40%, right?
40%. Yes.
Thank you. Now, the reason why you can see the combination of, and this is how to determine weighted average cost of capital. Don't forget that in our last class, I made mention of something when we were calculating the cost of equity. When we calculate the cost of equity that we have about 40% as the cost of equity. I mentioned something that where I actually bring out this question. Yes, there is one figure that I forgot to actually add to it. So that is what gives us high cost of equity of 40%. Of course, the cost of equity is usually higher than the what? Higher than the what? The cost of debt. And I've actually checked other question that I sent. I think there is no error there. It's just this first question, right? So, and that is what it is, right? Your cost of equity is always higher than the what? Than the cost of debt. There is no case, please, there is no case scenario you will have cost of equity of at least when you will have in exam maybe 15%, 12%, 10%. But if you are having cost of equity of 85%, there is problem. Abi 80%, there is problem, right? Or 40%, there is problem, right? So I think the least you can see 2%, 15%, yeah, 15%, 20%, you can even see 20%, right? But ensure you know what you are doing and just apply the rule because whether you may see cost of capital in May diet and it will be based on convertible, right? Determine the convertible value. Then you will now see conversion ratio and all those things, right? Now, if all this is established class, right? And this is the simple way to calculate the market value weighted average cost of capital given to you in the question. Now, we have calculated the market value weighted average cost of capital or post-tax weighted average cost of capital. We go ahead to the next question. No, before I move on, do you have anyone that have question? If you know you are not in my class yesterday that we started the solution, please don't ask question on ordinary shares and preference shares, but you can ask question on bank loan and redeemable debt, right? Unless if you say, oh, I've watched the video, but I did not understand this part, I can say, oh, watch it again, or I can explain to you, please. Because, okay, do you have anyone that have question? You can unmute your mic, please. Okay. Now, discuss how the capital asset pricing model can be used to calculate a project-specific cost of capital for Echo PLC class. Now, the project-specific cost of capital, this one will take us to the risk-adjusted cost of capital. I will not explain this part now. By yourself, when we start risk-adjusted cost of capital, you will be the one to even explain the process of capital asset pricing model, right? Now, the B part is that, okay, referring to your discussion to the key concept of systematic risk, business risk, and the financial risk. I can explain that here, and I will still explain when we get to portfolio theory as well, right? Or when we get to risk-adjusted cost of capital. Now, what is systematic risk? Systematic risks are risks that affect the general economy, right? You talk about the inflation rate, talk about the unemployment rate, talk about the exchange rate. Is a what? Is a business risk. Is a systematic what? Risk. It affects everybody. Then when you're talking about business risk, you could actually focus business risk in two ways. In your business risk, you could have systematic risk and unsystematic risk in the business risk. Now, business risks are risks that could say we can tailor it that say, oh, it's a risk that affects a particular business. Risk that affects you, not for you to achieve your goal, right? Probably you are producing low product. Probably you don't have enough customer. It's a risk that is affecting your business. It could be the risk of government policy, right? Like the CBN recapitalization policy. It has actually affected some banks, right? Right? Affected some business, right? Which is what? Bank. Is that also? Now, the financial risk are risks that affect a particular business in financial parts. For instance, now, inability to meet up with your short-term obligation is a financial risk. If you are having a legal risk, is a financial risk. If you're having a liquidity risk, is a financial risk. If you're having credit risk, is also a financial. You can see this risk would affect you not to achieve your what? Your objective. And that is why it is called a financial risk. You are not able to do what? Meet up with your obligation, right? Is that not so? And that is finance. So do we have anybody that have question? If you have question, unmute your mic. Let's talk. Please, if you have question, you can unmute your mic. So, in the absence of that, so discuss why cost of equity is greater than cost of debt. Please, we already know this one. I mean, okay, please, someone should, okay, you can unmute your mic. Explain why cost of equity is greater than cost of debt. Please, unmute your mic. Or should I call him? Abdurrahman, let me call him now.
Huh?
So why
So,
discuss why cost of equity is greater than cost of debt?
it's because of the risk, because of the risk involved. Because cost of debt is riskier than cost of equity.
Or you are missing it up. Oh. Which one is riskier? Is it the have more risk? Is it cost of equity or cost of debt?
The cost of equity and cost of debt.
No, you mentioned something. Which one have more risk? Is it equity or debt?
That is
You say
okay
I can.
for the investor. It is the equity that is riskier than the cost of debt.
Okay. That is noted. I will upload it. Okay. Then who else again? Thank you. Abidemi. Thank you, Abdulrahman. But please ensure you watch. Yeah, please ensure you watch the last video so that you can get how we calculate the total market value. Please. Then if you have anything, you can send to my DM or you just post to the platform. I will attend to it. Okay, Abdulrahman.
Noted, sir. Noted, sir. Thank you, sir.
Okay. Thank you. So who again? Rachel. Where is Rachel? Now.
Okay, cost of equity is more riskier than cost of debt. And in case
Abdulrahman
of
mentioned it. Okay.
liquidation,
Okay.
the debt holder are paid first before the
Thank
equity
you.
holder.
Thank you. God bless you. Just hold on. I don't need any point. Hold that point. Rachel. Rachel.
Okay, so let's say market expectation. So the cost of equity is influenced by market expectation.
Hmm. Interesting. Hmm. Wow. I love that. And there's a tax relief for cost of debt. That is why it's part of it. There are cost of debt, there is a tax relief. In cost of equity, there is no tax relief, right? The cost of equity is the minimum return that investors are expecting. Investors are expecting something, while the cost of debt, if the lender are not expecting anything, it is requiring that the debt holder, the company will pay the lender as at the date of what? As at the date of maturity. Thank you so much, everyone. Thank you, Rachel. Thank you, Abidemi. Thank you, Abderrahman. So, if that is established, I think we are done with this question, right? I will upload it on the YouTube so that if anyone you can watch it again, then you drop your question. Now, I think the next question is this Eco PLC as well. This Eco PLC statistics shows that students failed this question, and it is one of the number one question of Ican question. I think one diet like that, right? It is one of number one question, and most students failed this question, and it's very simple, right? And that is why I decided to bring it up. Now, the question three is adopted from ACCA by K-Plan. You can get K-Plan or BPP, right? As well as Ican is there. So now, this question four, class. Question four. Question four is on the YouTube. We will not solve this question four. APLC. You can check YouTube. You can check cost of capital questions. It is there. Just type cost of. Just use your search button and type cost of capital question, is there, right? You will see KPLC. I've explained this KPLC in detail in that video, right? Now, you see these 5 questions, the number 5, another problem. Now, let me tell you the performance. Examiner, it shows that student failed it woefully, right? And it's 15 marks question. Student what? Failed this woefully, right? So please, in our next class, we will solve this question, which is question, I think I'm looking at question 3, or we do this question 2 of it, right? Question 3 or question 2, right? But anyone you can attempt, please ensure you attempt it, right? So either any of the 2, we may likely do it in our next class, which is Wednesday, right? And we will just solve like 3 questions under the cost of capital. Then we move to risk adjusted cost of capital, which is another part. See, anyone who miss, if you don't understand cost of capital, that is the beginning of failure. This one is not it's just beginning of failure. Cost of capital, you must understand it, because every question, every topic, you will see, determine the cost of capital using the capital asset pricing model, right? So if you don't understand it, and that is where there will be problem, right? So in our next class, we'll look at any one of these questions. Please, I want you to go and practice question. Oh, the KPLC is on the YouTube. Watch it. Drop your question to the platform. I will definitely attend to it, right? So